please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Still tuned into Power Breakfast on CNBC TV18. Well, back home on Dalal Street, the depreciating rupee coupled with weak global cues and rising crude prices translated to one of the biggest one-day falls that we've seen in the past 6 months. The Nifty closed below the 11,450 mark. Sensex also shed almost 500 points. So it was a tough day for us, but how is today looking? Is it any brighter? Mangalam is here to tell us. Mangalam.
Unfortunately, it doesn't look any brighter apart from the fact that the SGX Nifty indicating a mild red cut instead of a sharper red cut that we saw yesterday. So let's recap trade yesterday. We had a 1.3% cut on the Nifty, about a 0.2% on the Sensex. The Nifty bank closing about 1%, and the mid caps, they underperformed by almost about 2%. And as you rightly pointed out, last 6 months, we saw the biggest fall, intraday fall on the Nifty. So 151 point decline. The last time we saw that was on March 16th, 2018. So that day we saw about a 165 point decline on the Nifty. The three reasons for fall: one, of course, we've been talking about the currency depreciation. Secondly, has been the crude, and third has been the weakness in the emerging market itself. Yesterday too, while we saw the developed indices across the world gain, we saw some movement in terms of the emerging markets which were lower. Today, the cues are, one, the Asian markets are in positive territory as far as Japan is concerned. So does that mean emerging markets are under pressure? Perhaps yes or not. That is something we have to watch out for. Hang Seng indicates a red cut. The second thing, crude has pulled back a bit, but is that enough for one to take, take note of that as far as the markets are concerned? Third thing, the officials, they are talking the rupee up. Yesterday, I believe there could have been some sort of a dollar selling in the markets as well to take the rupee higher from the levels that we saw, 72.67 thereabouts. Will that be enough or not? So these are the three key questions we need to answer. The SGX Nifty, like I said, indicates a mild red open. So does that mean that opening tick sees more decline, or will that opening tick see some bit of buying perhaps? Suppose that is a big question. Why? Because yesterday there was selling across lock, stock and barrel. The FII sold about 840 crores in the cash market. The domestic institutional investors sold about 300 crores in the cash market. And index futures out there is where the massive amount of selling came in. FII sold about 12,249 short contracts. That's about 4 short contracts added per long contract. They're now 47% long as against 64% long at the start of this series itself. Not just that, they're buying huge amounts of protection on the downside. 44,850 long puts added and around 17,000 short calls added. That's telling you that they are bracing themselves for a downside. If they do not get that, then there could be case for short covering, but we do not know. For that, we have to watch out for the first hour. If you take a look at the FII positioning in index options, of the 100 rupees that they've deployed over this series, 43% has been towards buying puts. So a lot of protection on the downside is being sought. The only couple of positives that we have, the first one, even at lower levels, even at the FII selling, the Nifty futures premium has actually expanded to 55 points. That's telling you a very small part of the street perhaps has gone long as far as the index is concerned. And that could also be because we're very close to the series low of 11,400 thereabouts. The maximum open interest in terms of puts is at 11,400, so we're just about 38 points from there. If that doesn't hold, then maybe there is a case we go to 11,263. If not, then can't rule out short covering till the 20-day moving average, which is 11,548.
And stocks?
A lot of stocks, Ekta. We start with the IT pack because of the rupee. So Macquarie has written a note. Remember that index has outperformed the Nifty by a factor of 4 from the start of this year. So Macquarie has said that they've built in rupee dollar assumptions of 70.8 for FY20. 3 to 4% changes in the dollar drive 0 to 13% change in the EPS. They believe the maximum positive impact on IT stocks would be TCS, Tech Mahindra and Persistent. And they've upgraded Wipro and Hexaware to outperform on account of valuation. So that sector will be a buzz, apart from, of course, the pharmaceutical sector, which is a rupee sensitive. Macquarie has written on Ujjivan, they maintain their outperform rating while they've cut the target price. They say that the recent correction of 15% that we've seen on Ujjivan offers an attractive entry price. Remember, the stock has corrected about 15%. in the last 3 months itself. We will be watching out for banks. We will definitely be keeping an eye out on financials, primarily because of the sensitivity that they have to the 10-year bond yield, to the rupee, as well as crude prices basis fiscal deficit projections. Reliance Home Finance, they came out with their numbers yesterday, the first quarter numbers. Let's see how the stock reacts to that, given the time at which they've come out with the numbers. The revenues moved higher, 404 crores, and the net profit has come in at 48 crores. This compares with 34 crores. Shrey Infra, the equipment finance business has received a SEBI nod for the IPO, so that is something that the street will keep an eye out on as well. Mild positive for Container Corp. Agreement signed between the company and CWC to operate CWC's container freight station facility at Pipavav Port. So mild increase in the business. And Sun Pharma, finally, you tell us that it is a sentiment positive, not too much. One of their subsidiaries has agreed to acquire 18.75% stake in Tarsius Pharma for about $3 million.
Focusing on the big story then, the rupee has stumbled to a new all-time low of 72.67 against the dollar in yesterday's session, though recovered marginally to end at 72.45. Lata Venkatesh caught up with the former RBI Governor Raghuram Rajan and began by asking him if the current situation suggests that we are on the verge of something ugly for emerging markets.
The Argentinian and Turkish case are special. They have had a history of problems, and this has come to the fore recently. It does signify some concern for other emerging markets. This is not a good time to abandon macro stability. You have to focus on reassuring markets that you are good for it. And unfortunately, countries that have growing current account deficits, that have large fiscal deficits, look particularly vulnerable at these times.
Well, how worried should we be about India's current account deficit and trade deficit? The last July number, trade deficit number, was as high as 18 billion. And at that pro rata rise in trade deficit, it could be 3% current account deficit.
Yes, it's that, and you also have a large fiscal deficit. Of course, the center has been relatively moderating, but the states have increased their fiscal deficit. And when you aggregate government fiscal deficit, it is quite large. I think the fact that India is growing quite strongly gives it some positive. But in general, I think we have to pay attention. Now, the current account deficit is partly a result of oil prices going up, but it's also partly a result of our export sector having been hit by the twin shocks of demonetization as well as the GST. We need to do everything on a war footing to get the export sector back up and running. Of course, the depreciation in the rupee thus far will help, but I think it's also important to focus on the impediments that hold it back to make sure that we are signaling to the markets that we're in the process of bringing down the current account deficit. It also means that we have to be very careful on the fiscal front. We cannot afford an election year budget going forward, given the kind of turmoil that there is there in financial markets. It has to be a responsible one.
Okay. Well, so you're speaking in terms of cures that the rupee depreciation should help, but we should try and do more for the export sector and keep a very sharp eye out on macros like fiscal deficit. But what about needing instruments like interest rate hike, which we had to resort to in 2013, or even something like the special NRI bond, the FCNRB scheme? Will it come to that?
Well, I think those are always weapons you have in the armory. But I think it's important, and this is one place where we've made a very important move since the last crisis. It's very important that the RBI continue to signal, as it has done so far, its concerns about keeping inflation on track, about raising interest rates whenever appropriate to fulfill its inflation objective. That gives investors confidence that the rupee is not going to go into free fall, because ultimately inflation will be under control and the rupee can get significantly undervalued if it continues falling at these rates.
Well, there is no respite from high fuel prices, with petrol and diesel prices hitting fresh record highs yet again. In Mumbai, the price of petrol has now been hiked by 14 paise to 88.26 rupees per litre, while diesel is up 15 paise to 77.47 rupees per litre. And even as fuel prices continue to burn the common man's pocket, the centre as of now has ruled out any excise duty cut. Top government officials tell CNBC TV18 that any reduction in excise will increase the fiscal deficit. Sapna Das has more details. Sapna, over to you.
Well, the centre is clearly indicating that it's probably not very comfortable or not in the mood to even think about reduction of excise duties on petrol and diesel. Every 2 rupee cut on petrol and diesel will cost the exchequer around 28 to 30 odd thousand crores. But of course, the centre's hit may be limited because this is also shared by the state governments under the 42% devolution formula. So the hit to the centre will be reduced to that extent. Nevertheless, the overall envelope that they're looking at is around 28 to 30,000 crores, and obviously anything on this front will have to impact your developmental expenditure. There may have to be budget cuts for that. Also, that will impact your rupee levels, and your bond yields will go through the roof. They're already rising. They're already very high right now. Plus, whatever benefits that have been given on GST and the income tax front so far, all put together, has already cost the centre incurring the cost of the incurring benefit is somewhere around 1.8 to 2 lakh odd crores. So that also has to be kept in mind. So this is a case that the centre is building up in terms of not trying to tweak the excise duty on petrol and diesel, but still we have to keep a watch on how the crude behaves and how the rupee really pans out, and keep our fingers crossed on that front.
Yes, in fact, thanks Apna for that. Let's focus on the rupee then. We will be tracking that closely. The Indian currency has tumbled to hit a new all-time low of 72.67 on an intraday basis against the dollar. This emerging market contagion, coupled with a stronger dollar demand from importers, continued to pull the rupee lower. But what's the trajectory going forward? Here is some opinion from experts.
The government has come out with very, very positive statements over the weekend, saying that they are not really appreciative of this extent of rupee depreciation, which is a slight change from the kind of narrative that they were talking about last week, which was to say that they were probably comfortable because it was a global market phenomena. In my pecking order, I would possibly place things like measures to improve the current account deficit, like measures to bring down imports and encourage exports. Any of those measures should come first. Oil currency window for the oil companies separately from Reserve Bank of India, that will probably come second. And then somewhere in between, you can also think about the Reserve Bank of India intervening more aggressively in the spot market by using its reserves to sell in the spot market.
Well, we said when the dust settles, they will look at the value in India, and what is very clear is that across the EM universe, the dust hasn't settled yet. Here we are, we're less than 10 days away from a US rate hike. We've had strong US numbers on Friday in the jobs with the jobs report, and still investors are preferring the dollar over the EM universe. Now, if you look at the 5-year forward rate, 5-year forwards are just approaching 90 to the US dollar. So if you think the rupee is going to be below 90 in 5 years' time, then you must be buying bonds.
Okay.